Hi, I'm Mike Larson for Money and Markets TV. Central banks around the world have been raising interest rates for months now, but the Federal Reserve is still pledging to keep the easy money flowing. Ben Bernanke is dragging his feet, ignoring rising energy and food costs. But now it looks like Bernanke's battling dissension from within his own ranks. In just the past few days, Philadelphia Fed President Charles Plosser warned that monetary policy will have to reverse course in the not-too-distant future and begin to remove the massive amount of accommodation it has supplied to the economy. He added that failure to do so in a timely manner could have serious consequences for inflation and economic stability. St. Louis Fed President James Bullard said the economy is looking pretty good, and that the Fed should see if we want to decide to finish the program or to stop a little bit short. Now, the program in question he's talking about is QE2, the $600 billion money-printing boondoggle that's helping drive inflation higher. Bullard added that we can't be as accommodative as we are today for too long. We'll create a lot of inflation if we do that. Finally, Dallas Fed President Richard Fisher went even further, telling a European audience that we've done enough and we're at risk of doing too much. Fisher even went so far as to say that the Fed's dual mandate of controlling inflation and boosting employment should be changed. He wants the Fed to have zero responsibility for employment and to focus solely on inflation. Now, there's no sign yet that Bernanke's on board with this new tone. He hasn't officially signaled any intention to end QE2 early or to raise interest rates from their current range of 0 to 0.25%. But the hawks are definitely turning up the heat, and it's high time that investors like you pay attention. Why? Because easy money is a key driver for many of the market moves we've seen lately. Think about it. Why does crude oil keep going up and up on the same news? Why do stocks surge right back after every correction? Why do junk bond prices keep rising? And why is the dollar falling virtually non-stop? The answer is that the Fed is always at the ready with billions and billions of freshly printed dollars. So it stands to reason that if anything interrupts that flow of easy money, whether it's the end of QE2, a rise in interest rates, or both, the asset markets are going to get whacked. That's why this ever-changing tone in Fed remarks is so important. Speaking of which, the Federal Open Market Committee meeting at the end of this month is going to be very important to watch. That'll be the first time ever that the Fed holds a post-meeting press conference. That's right, rather than hiding behind prepackaged statements, Ben Bernanke is going to stand in front of the microphone and explain the Fed's actions. The first conference is set for April 27th, followed by June 22nd and November 2nd of this year. If Bernanke shows any shift at all toward the hawkish side of the committee, we're going to see some real market fireworks. The trend toward a flatter yield curve will likely accelerate, and the stock market could take a tumble. So get ready, because it may soon be time to make some portfolio adjustments. I'm Mike Larson for Money and Markets TV. Thanks for watching.